Capital gains tax explained. Short term versus long term. You just made $5,000 investing in Apple stock. Sounds great, right? Wrong. The IRS might take up to 40% of that, leaving you with $3,000. But here's the thing. If you'd waited just one extra day, you could have kept over $4,000. That's the power of understanding capital gains tax. And today, we're breaking down exactly how to keep more of your money. Welcome back. I'm your guide through the financial maze nobody explains clearly. If you're investing in Robinhood, Fidelity, or anywhere else, you need to understand this. It's literally thousands of dollars waiting for you to claim. Let's start with the basics because this gets confusing fast. Part 1. What is a capital gain? A capital gain is profit. You buy something for less. You sell it for more. That difference is your gain. That's it. Whether it's stocks, real estate, or your vintage Nintendo collection, profit equals capital gain. And the IRS wants a piece. Here's where most people mess up. They think all capital gains are taxed the same. They're not. There are two buckets. And this is where the magic happens. Part 2. Short-term capital gains. The expensive mistake. If you hold an investment for 1 year or less, it's short-term, and short-term gains are taxed like regular income. This is critical. Your short-term gains get added to your regular salary. And boom, you're paying your ordinary income tax rate. Let me show you what this actually means in dollars. Say you make $70,000 a year at your job. You're in the 24% federal tax bracket. You buy Tesla stock with $2,000. 3 months later, it shoots up to $7,000. That's $5,000 profit. You sell it. That $5,000 gets added to your $70,000 income. Now you're at $75,000. That profit gets taxed at 24%. You owe $1,200 in federal taxes on that gain alone. That's not including state taxes, which could add another 5 to 13% depending on where you live. Some of my subscribers live in California, where state tax goes up to 13%. They'd pay almost 37% total on that $5,000 gain. They keep $3,100. The IRS takes $3,900. This is why day traders get crushed. They're constantly triggering short-term gains. They're not building wealth. They're building tax bills. But here's where it gets beautiful. Part 3. Long-term capital gains. The wealth builder. Hold that same investment for more than 1 year, and everything changes. Long-term capital gains get preferential tax treatment. This is the government literally rewarding you for patience. Long-term rates are either 0, 15, or 20% at the federal level, not based on your income bracket, based on the gain itself. This is different. Let me show you the same scenario. But long-term, you buy Tesla with $2,000. It goes to $7,000. That's $5,000 profit. But this time, you wait 14 months instead of 3. Now it's long-term. If you're a single filer making $70,000, your long-term gains are taxed at 15%. You owe $750 federal tax. You keep $4,250. Compare that to the short-term scenario where you kept $3,100. That's a $1,000 difference on one trade. Real talk. I know someone who made the opposite mistake. Sold Microsoft after 11 months. Paid short-term rates. Then realized he should have waited 1 more month. He paid an extra $1,800 in taxes on a $15,000 gain. 1 month. That's the power of understanding this. If you're investing in an S&P 500 index fund through Fidelity, this matters. If you're in a 401k, you're protected because you're not paying taxes on gains until retirement. If you're in a Roth IRA, you're paying 0% on long-term gains forever. That's why people obsess over Roth IRAs. But for taxable brokerage accounts, you need this strategy locked in. The move. Don't trade like you're gambling. Buy quality companies. Hold them. Let them compound for over a year. Pay long-term rates. Build real wealth instead of anxiety and tax bills. This strategy alone could save you thousands every single year. That's money staying in your account instead of going to the government. Now here's what I want you to do. Comment below one stock you're holding. And tell me how long you've owned it. Let me know if you're in short-term or long-term territory. And subscribe. Hit that bell. New videos every single week breaking down the financial moves nobody teaches you. You've got this.